Welcome to our deep dive into the world of commodities investing. Commodities are raw materials or primary agricultural products that can be bought and sold, such as gold, oil, or wheat. Investing in commodities offers a unique way to diversify your portfolio and hedge against inflation. In this video, we'll explore the basics of commodities, why investors are drawn to them, and how you can get started. Whether you're a seasoned investor or just curious about new opportunities, understanding commodities is essential in today's global economy. Let's begin by defining what commodities are and why they matter. Commodities are physical goods that are interchangeable with other goods of the same type. They're typically divided into two main categories: hard and soft commodities. Hard commodities include natural resources like gold, oil, and metals, while soft commodities are agricultural products such as coffee, wheat, and cotton. These assets are traded on specialized markets and exchanges around the world. The prices of commodities are influenced by global supply and demand, making them a dynamic and sometimes volatile investment choice. Now, let's look at the different types of commodities in more detail. Hard commodities are natural resources that are mined or extracted from the earth. Examples include gold, silver, oil, and natural gas. These commodities play a crucial role in the global economy, serving as the backbone for industries ranging from energy to electronics. Investors often turn to hard commodities as a hedge against inflation or economic uncertainty, since their value tends to rise when traditional markets are unstable. Let's take a closer look at gold and oil, two of the most popular hard commodities among investors. Gold has been valued for thousands of years, not only as a precious metal for jewelry but also as a store of value. Investors often flock to gold during times of economic uncertainty, as it is seen as a safe haven asset. Gold's price is influenced by factors such as inflation, currency fluctuations, and geopolitical events. It's traded globally and can be bought in various forms, including bars, coins, and exchange-traded funds. Let's explore why gold remains a favorite among commodity investors. There are several ways to invest in gold. You can purchase physical gold in the form of bars or coins, which you can store at home or in a secure vault. Alternatively, you can invest in gold exchange-traded funds (ETFs), which track the price of gold and are traded on stock exchanges. Another option is to buy shares in gold mining companies, giving you exposure to the industry's performance. Each method has its own risks and benefits, so it's important to choose the one that fits your investment goals. Oil is one of the most widely traded commodities in the world. It powers industries, transportation, and even our homes. The price of oil is influenced by global supply and demand, geopolitical tensions, and production decisions by major oil-producing countries. Investing in oil can be done through futures contracts, oil ETFs, or shares in oil companies. However, oil prices can be highly volatile, so it's important to understand the risks before investing. There are several ways to gain exposure to oil as an investment. Futures contracts allow investors to speculate on the future price of oil, but they can be complex and risky. Oil ETFs offer a more accessible way to invest, tracking the price of oil or a basket of oil-related assets. You can also buy shares in oil companies, which may provide dividends and capital appreciation. Each approach comes with its own set of risks and rewards, so careful research is essential. Soft commodities are agricultural products that are grown rather than mined. Examples include coffee, wheat, sugar, and cotton. These commodities are essential for daily life and are influenced by weather, crop yields, and global demand. Investing in soft commodities can provide diversification and help hedge against inflation. However, prices can be volatile due to unpredictable factors like climate change and geopolitical events. Let's look at some popular soft commodities and how to invest in them. Coffee is one of the most traded soft commodities worldwide. Its price is influenced by weather conditions in major producing countries, global demand, and even political events. Investors can gain exposure to coffee through futures contracts, ETFs, or shares in coffee-producing companies. While coffee can offer attractive returns, it's important to be aware of the risks, such as crop failures or sudden changes in demand. Let's see how coffee fits into a diversified commodities portfolio. Wheat is a staple food for billions of people and a key soft commodity. Its price is affected by factors such as weather, crop diseases, and international trade policies. Investors can access wheat markets through futures contracts, ETFs, or agricultural company stocks. Wheat can be a good addition to commodities portfolio, offering diversification and potential returns. However, it's important to monitor global trends that can impact supply and demand. Sugar and cotton are two other important soft commodities. Sugar prices are influenced by weather, crop yields, and government policies, while cotton is affected by global demand for textiles and fashion trends. Investing in these commodities can be done through futures, ETFs, or shares in related companies. Both sugar and cotton can add diversity to your portfolio, but they also come with risks such as price volatility and changing consumer preferences. Commodities are traded on specialized exchanges such as the Chicago Mercantile Exchange, CME, and the New York Mercantile Exchange, NYMEX. These platforms provide a regulated environment for buyers and sellers to trade contracts for future delivery of commodities. Understanding how these exchanges work is crucial for anyone interested in commodity investing. They help ensure transparency, liquidity, and fair pricing in the market. Futures contract is an agreement to buy or sell a commodity at a predetermined price at a specific time in the future. These contracts are standardized and traded on exchanges. Futures allow investors to speculate on price movements or hedge against potential losses. However, they can be complex and carry significant risk, especially for inexperienced investors. It's important to understand how futures work before getting involved. Commodities can be traded in the spot market, where transactions are settled immediately, or in the futures market, where delivery occurs at a later date. Spot markets are ideal for those who want to buy or sell physical commodities right away, while futures markets are better suited for speculation or hedging. Understanding the difference between these markets can help you choose the right strategy for your investment goals. Commodity exchange traded funds, ETFs, offer a convenient way to invest in commodities without dealing with physical goods or complex futures contracts. These funds track the price of a single commodity or a basket of commodities and are traded on stock exchanges. ETFs provide liquidity, diversification, and ease of access, making them popular among retail investors. However, it's important to research the underlying assets and fees before investing. Commodity mutual funds pool money from multiple investors to invest in a range of commodity-related assets. These funds are managed by professionals and can include physical commodities, futures contracts, and shares of commodity companies. Mutual funds offer diversification and professional management, but they may have higher fees compared to ETFs. Consider your investment goals and risk tolerance when choosing between mutual funds and other options. Investing in commodity stocks means buying shares of companies involved in the production, processing, or distribution of commodities. Examples include mining companies, oil producers, and agricultural firms. These stocks can provide exposure to commodity prices and may offer dividends. However, they are also subject to company-specific risks, such as management decisions or operational issues. It's important to research each company before investing. One of the main reasons investors add commodities to their portfolios is diversification. Commodities often have a low correlation with stocks and bonds, meaning their prices may move independently. This can help reduce overall portfolio risk and improve returns over time. By including a mix of commodities, investors can better weather market volatility and economic downturns. Commodities are often seen as a hedge against inflation. When the cost of goods and services rises, the prices of commodities like gold and oil tend to increase as well. This can help preserve the purchasing power of your investments during periods of high inflation. However, not all commodities respond the same way, so it's important to diversify across different types. While commodities can offer attractive returns and diversification, they also come with risks. Prices can be highly volatile, influenced by factors such as weather, geopolitical events, and changes in supply and demand. Additionally, some commodities require specialized knowledge to trade effectively. It's important to understand these risks and only invest what you can afford to lose. Commodity prices can swing dramatically in short periods. Factors like natural disasters, political instability, or sudden changes in demand can cause sharp price movements. This volatility can create opportunities for profit but also increases the risk of losses. Investors should be prepared for price fluctuations and consider using risk management strategies. Any commodity investments, especially futures contracts, involve leverage. This means you can control a large position with a relatively small amount of money. While leverage can amplify gains, it also increases the potential for losses. Margin calls can force investors to sell at a loss if prices move against them. It's important to use leverage cautiously and understand the risks involved. Liquidity refers to how easily an asset can be bought or sold without affecting its price. Some commodities like gold and oil are highly liquid and traded globally. Others, such as certain agricultural products, may have lower liquidity, making it harder to enter or exit positions. Always consider liquidity when choosing which commodities to invest in. Physical commodities often require storage and transportation, which can add to the cost and complexity of investing. For example, storing gold securely or transporting oil requires specialized facilities. These logistical challenges are one reason many investors prefer financial instruments like ETFs or futures, which don't involve handling the physical commodity. Commodity markets are regulated to ensure fair trading and protect investors. Regulations can vary by country and commodity, affecting how and where you can invest. It's important to stay informed about the rules governing your chosen markets, as changes in regulation can impact prices and trading opportunities. Global events such as wars, natural disasters, and pandemics can have a significant impact on commodity prices. For example, a hurricane in the Gulf of Mexico can disrupt oil production, causing prices to spike. Staying informed about world events and understanding their potential effects on commodities is crucial for successful investing. The prices of commodities are largely determined by supply and demand. When supply is limited and demand is high, prices tend to rise. Conversely, oversupply or reduced demand can cause prices to fall. Understanding these dynamics is key to making informed investment decisions in the commodities market. Technology has transformed commodity trading, making it more accessible and efficient. Online trading platforms allow investors to buy and sell commodities from anywhere in the world. Advanced analytics and real-time data help traders make better decisions. As technology continues to evolve, it's likely to play an even bigger role in the future of commodity investing. Environmental issues such as climate change, droughts, and natural disasters can have a major impact on commodity prices, especially agricultural products. Investors need to consider these risks when building a commodities portfolio. Sustainable investing in environmental, social, and governance (ESG) factors are becoming increasingly important in the commodities market. Geopolitical tensions, such as conflicts between countries or trade disputes, can cause sudden changes in commodity prices. For example, sanctions on oil-producing nations can restrict supply and drive up prices. Investors should monitor geopolitical developments and consider their potential impact on the commodities they invest in. Commodities are often priced in US dollars, so changes in currency exchange rates can affect their value. A stronger dollar can make commodities more expensive for foreign buyers, reducing demand and lowering prices. Conversely, a weaker dollar can boost demand and prices. Currency risk is an important consideration for international investors. Deciding how much of your portfolio to allocate to commodities depends on your investment goals, risk tolerance, and time horizon. Some investors dedicate a small percentage to commodities for diversification, while others may take a more aggressive approach. It's important to regularly review your allocation and adjust as needed based on market conditions. Commodities can be suitable for both long-term and short-term investment strategies. Long-term investors may use commodities to hedge against inflation and diversify their portfolios, while short-term traders might seek to profit from price swings. Each approach has its own risks and rewards, so choose the strategy that aligns with your financial goals. Successful commodity investing requires thorough research and analysis. This includes studying supply and demand trends, monitoring global events, and understanding the factors that influence prices. Many investors use technical and fundamental analysis to make informed decisions. Staying up to date with market news and reports is essential for success. Selecting a reliable broker is crucial for commodity investing. Look for brokers with a strong reputation, transparent fees, and access to the markets you're interested in. Some brokers specialize in commodities and offer advanced trading tools, research, and support. Take the time to compare options and choose one that meets your needs. Before investing in commodities, it's important to set clear investment goals. Are you looking for long-term growth, income, or a hedge against inflation? Defining your objectives will help you choose the right commodities and investment strategies. Regularly review your goals and adjust your approach as needed. Managing risk is essential when investing in commodities. This can include diversifying across different commodities, setting stop-loss orders, and limiting the use of leverage. Understanding your risk tolerance and using appropriate strategies can help protect your investments from large losses. Commodities investments can have unique tax implications depending on your country's laws and the type of investment. For example, profits from futures contracts may be taxed differently than gains from ETFs or physical commodities. Consult a tax professional to understand your obligations and optimize your tax strategy. Many new investors make mistakes such as overleveraging, failing to diversify, or ignoring market trends. Avoid chasing short-term gains and always do your research before making investment decisions. Learning from the mistakes of others can help you build a more successful commodities portfolio. The commodities market is constantly evolving with new developments happening every day. Stay informed by following news sources, market reports, and expert analysis. Being proactive and adaptable will help you make better investment decisions and respond to changing market conditions. Building a well-balanced commodities portfolio involves selecting a mix of hard and soft commodities, choosing the right investment vehicles, and managing risk. Regularly review your portfolio and make adjustments as needed to stay aligned with your goals. Remember, patience and discipline are key to long-term success. During the 2008 financial crisis, gold prices surged as investors sought safety amid market turmoil. This case highlights gold's role as a safe haven asset and its ability to preserve value during economic downturns. Studying historical examples can provide valuable insights into how commodities behave in different market conditions. Oil prices have experienced dramatic swings, such as the 2020 price collapse due to reduced demand during the pandemic. This event demonstrates the volatility of oil and the importance of understanding market dynamics. Learning from real-world examples can help investors prepare for future challenges. The commodities market is evolving, with new trends emerging such as the rise of renewable energy, increased focus on sustainability, and technological advancements. Staying ahead of these trends can help investors identify new opportunities and adapt their strategies for the future. Investing in commodities like gold, oil, and agricultural products can offer diversification, inflation protection, and potential returns. However, it's important to understand the risks, do thorough research, and use sound investment strategies. By staying informed and disciplined, you can make commodities a valuable part of your investment portfolio. Thanks for joining us on this journey through the world of commodities investing.